Hi everyone, thank you so much for taking out time this afternoon. So I'm Jatin Tehri. I qualified 19 years back as a CA, and I started my career with one of the big four consulting firms. And then I also moved into a real estate company which was funded by Morgan Stanley. And then subsequently, I joined a publishing company where I was the finance head, and I gained a lot of acquisition opportunities there. And then subsequently, our company also got acquired, and I came out and I started my practice. So that was year 2009 late when I started my practice. So in my practice, I am taking care of both sides, as in the audit as well as advisory side. On the audit, we do uh, audit, assurance, taxation, and on the advisory side, we do a lot of merger acquisition, valuations, due diligence, IPO, and forensic investigations. So that's a brief background about myself. And now I will straight away come to our today's topic, which is a fraud investigation, which is very close to my heart as a topic, I would say. Not, I mean, as a practice, it's a good thing to have. But I started as a hardcore statutory auditor while I was working with one of the big fours. So eventually, I learned and gained experience about the forensic investigations and all other things, and that's how I have now started doing a lot of for fraud investigations as well. So I come to the today's topic. Please let me know if you are able to see my screen. Is my screen visible?
Yes, Jatin.
Okay. Okay. So our today's topic is fraud investigations, and I straight away come to the topic. So I have already covered my background. So we come to fraud investigations. So first and the foremost thing is to understand what is a fraud. So there are a lot of definitions given in SA 240, Companies Act, standards on internal audit, and all other things. And I'll just take you through one by one. So the Company Act says the fraud in relation to affairs of the company includes any act, omission, concealment of any fact, or abuse of any of the position by any person with an intent to deceive or gain undue advantage, to injure the interest of company or its shareholders. So that's a company law definition specific to the companies. So there is another definition which is given by SA 240 on the fraud, which is related to the auditor's responsibility relating to fraud in audit of financial statements. So this says an intentional act by one or more individuals among management, those charged with governance, or employees, or any third party, involving use of deception to obtain any unjust or illegal advantage. Similar, the definition has been given by standards on internal audit. So, what is common between these three things? Or you could say, what is the difference between a fraud or mistake? So, the one word answer is intention. So, each and every definition covers the intention and the specific act which is done in any unjust advantage out of the situation. So, that's the brief background on the fraud. So we also cover up the fraud auditing. So what is a fraud auditing? Fraud auditing is when a person searches for the numbers of the financial statements which are not matching. So this is a fraud auditing. So when we do a statutory audit, we actually look for a financial document which has been given to us by the management or by the company. But in the fraud auditing, we actually try and get the information which is sourced from the third party. And that's how we try to match the outside information and the inside information to verify whether these two things are matching or not. And specifically, and this has been given by the study material on forensic accounting and fraud detection issued by ICI, and it says that a fraud audit is not an investigation. So investigation is something very, very different. Fraud auditing is used to identify fraudulent transactions, not to figure out how they were created. So this is the definition given by the study material on FAFD issued by ICI. So what are the type of frauds which are there? So there are multiple kind of frauds which are there in this entire world, but we will discuss a very brief which is relevant to us, which is like a bank fraud, corporate fraud, cyber frauds, employee frauds, vendor frauds, or insurance frauds. So these are a few kind of frauds which are related to the chartered accountants. As we are covering up the topics for the CAs, these are a few frauds which are related more towards the CA practices. So this is Fraud Watch, and this is a very, very hot topic. I'm sure everyone is looking into this on a day in, day out basis, where you can say that number of frauds, if we look at the top left corner, the number of frauds since last many, many years, it is increasing year on year. But you would see the number was very big in terms of the amount involved in 2021. That was a COVID period when government came out openly and said to all the banks that okay, whatsoever is there, let's reveal it and let's come out in the open, because this is the time when we should clean our balance sheets for the banks. So the number was 1 lakh, more than 1 lakh crore in 2021 financial year, when the number of fraud was approximately 7,000. This was also an era when IBC was also pushing for a lot of frauds to come out. And of course, we cannot miss on the NAFRA proceedings. These days, a statutory auditor is on the, I would say, I mean, NAFRA is looking at the statutory auditors with a very, very, a lens, and they want to investigate into each and every financial statement. So this is becoming very important for all of us to be very vigilant, because now we have got another authority which is beyond ICI taking care of our work, and they're verifying our work. So what is the difference between a statutory audit and a forensic audit? So when we do a statutory audit, we are provided information by the management. And of course, we are also provided a lot of information when we do a forensic audit also by the management. But we verify that information from a third source of information as well when we do a forensic audit. When we do a statutory audit, we express our opinion on the true and fair, and we give an audit report towards that. But when we do a forensic audit, we determine the correctness of the accounts or whether any fraud has actually taken place or not. The kind of techniques when we talk about on the statutory audit, these are like the substantive and the compliance procedure, which is a typical going on for decades. Whereas when it comes to the forensic audit, we analyze the past trend and substantive or in-depth checking of the selected transaction. So it is not specifically related to any financial period or financial year. This is actually defined by the authority which is giving us the task to do a forensic audit, whether it could be for a 1 year or a 5 year or even for a matter of 10 years also. But when we do a statutory audit, it is typically like a quarterly audit when it comes to the limited review, it comes to a half yearly audit or annual financial year audit as well. So the period is specific when it comes to the statutory audit. Of course, the period is also defined in IBC as to 1 year or 2 years related to the related party or non-related party transactions as well. So the forensic audit defines specific timelines for which the audit has to be done. Just one more example. For example, when a bank appoints a forensic auditor, they specifically say, okay, you want to get a forensic done from this to this period. And this is based on my experience that they specifically define not even 12 months or 18 months. They will define a specific period based on their internal assessment as to how the funds have been utilized by the promoters or by the company who had taken a bank loan. So it varies from the authority to authority which wants to give us a forensic audit assignment. So when it comes to the verification of stock, realizability of current assets, liability, and all other things, typically, besides doing our substantive and compliance procedures, we also rely on the management representation, certificates, and all other things when we are doing the statutory audit. But when it comes to the forensic audit, it is like an independent verification of all the suspected selected items, and we try to carry out a thorough third-party investigation. And when we talk about the off-balance sheet item, typically we used to vouch the arithmetic accuracy or compliance with the procedure, whereas in the forensic audit, we do a proper regulatory and proprietary verification of all the contracts and all the transactions as well. So which typically means that as a forensic auditor, we have all the right, and we should also verify whether any kind of contract was entered by the management was in the interest of the company or not, like a CAG audit. But we try to find the intent, whether the funds have been misutilized during that contract or transaction or not. Of course, as a, you can say, as a reasonable person, we have all the right to rely on the management that there could be a business decision, and the business decisions can also go wrong. But as we discussed in the beginning itself, what is the difference between a fraud and a mistake? We also have to verify the intent of the management uh, as to whether they wanted to siphon off the funds, or they were actually doing a right business, and there were losses due to any of the decisions. So we have to be very vigilant about those things. When it comes to the adverse finding, how we report to that, we have all the right as a statutory auditor to give a negative report, qualified opinion, disclaimer of opinion, or any other thing. But when it comes to the forensic audit, typically, whenever we are giving any sort of adverse opinion, this leads to a litigation, and we define specifically on the legal determination of the fraud, and we should also try and name the people involved into that fraudulent activities. That's the typical difference between a statutory audit and a forensic audit. So if I uh, recap the entire thing, uh, beyond what has been provided to us by the management, we try to gather information from this third party or third sources, and we try to validate those things with what has been provided to us by the management. This is a typical difference between a forensic audit and a statutory audit. So now we come to what kind of techniques are available as far as the forensic audit is concerned. So this can be divided into three parts. One is an analytical part, second is technology, and third is investigative. So in the analytical part, the steps involved are understanding the business, identifying possible frauds that could exist, and that's a pure analytical part where the judgment of the auditor is involved. And basis our experience, we try to find out any leads which could take us to the entire gamut of the fraudulent transactions or the activities, and then we catalog all possible fraud symptoms. That's the analytical part. But there are cases, and typically in large organization, there is a very large amount of data which is involved into any investigation process. So typically we use technology to gather that data and try and extract whatever additional symptoms could be extracted from that data. Then basis that data analysis and all other things, we try to analyze the results, whether this is useful for us or not useful for us, or how we can actually substantiate that and take to our next level of reporting and all other things. And then subsequently is the investigative portion, where whatever data we have analyzed, whatever data we have verified, we take it to the next level, where we try to investigate the symptoms. For example, I mean, I'm just trying to create a hypothetical example for better understanding. For example, a company is involved into buying and selling, like a trading activity. I mean, I can think of some of the industries, but I don't want to name it so that nobody thinks that there is some biasness onto it. So, for example, some company is involved into any trading activity. They are buying and selling some of the products. So there is a possibility that the previous trends had been different and the current trends had been different. So basis that difference of the trends, we have to substantiate whether those trends were related to the entire industry or this is specifically related to my industry. For example, if I'm dealing in any food item, typically the market prices are almost same for all the companies in the industry. So we have to analyze what is my input output ratio, or what is my buying or selling price, and what had been the buying or selling price of the competitors. That will give us a very good analytical understanding whether we are going into the right direction or not. So there could be cases, and I have seen during my investigations, there had been instances where not only one company or two company, the entire industry went into red because of multiple restrictions, or for example export bans or any other thing, which gives us a very good understanding that okay, understandable that there had been losses into the company, and there could be bad decisions also by the management, but there could be reasons beyond the control of the management. So we have to understand that and then dig it further so that we could lead to a fair assessment of whether the fraud has happened or not. And that's what I was trying to make it understandable. So then subsequent to that, whatever we have investigated, we do a follow-up for that, and that's an optional exercise. And if we are doing it for the management, and management also wanted us to investigate into the fraudulent transactions and all other things, we also help the management to automate the detection procedures as well. That's very crucial, and that's applicable in a lot of banks also. So then, yes, this is the slide where I wanted to emphasize a bit that what is the difference between any other audit and a forensic audit. That's the third party investigation, which we have just now discussed, and what typically a third party investigation involves. And maybe we can do a next round of session with any of a expert who deals with any third party investigations also. And I could bring in some experts who are like ex-intelligence or the similar kind of background, which helps a lot of, I would say, professionals in doing a field intelligence, field surveillance, off-site interviews, interrogations, retrieval of records and information, doing some sort of a discrete inquiries, imaging, disk analysis, forensics, and data analytical things. So these are some of the things which I have mentioned specifically, where whenever a chartered accountant is doing any sort of forensic investigations, they need these kind of things when it comes to any sort of field investigation, surveillance, or any other things. So maybe we can do and this is a topic which is very, very vast, and we can have a very separate session on this with any of the expert involved into this process also. So coming to what kind of opportunities are available for the chartered accountants, and this is very, very vast, and I really love this slide because of the reason that no matter, see, people think that this is a expert's job. I understand this is an expert job to do a forensic audit, but what can a chartered accountant as a statutory auditor do, and what can an internal auditor do when he's doing his job to further investigate and try and find out any opportunity for himself or even for the company. I mean, if you are raising any concern that there could be a fraudulent transaction while doing the internal audit, we are actually doing a favor to the management by telling them, okay, these are the problems happening in, which requires a further and detailed investigation into it. So I'm just going to cover a small amount of time every category. So very first and the foremost is conventional investigation assignments, where a specific assignment is given by the banks or the management or any other organization or authority, where they say, okay, we know there could be a fraud into the company, and let's do a conventional investigation into that. Similar to that, there are bank frauds involved, where the bankers appoint the forensic auditors. Then there are business risk evaluation exercises also done by a lot of NBFCs, insurance companies, and all other things, where they want the auditors to evaluate what kind of risks are involved and whether there could be a fraud into the organization or not. And that's also a requirement by the company law to do a proper framework for the risk assessment into the organization. Similar to that, there are insurance claim frauds, where a lot of agencies are providing the support in terms of verifying all kind of frauds which could happen while uh, investigating or while processing the insurance claims. Similar to that, compliance verification process is also there. So there are very large list of activities roaming around the forensic exercise, and this could be done by the statutory auditors, internal auditors, or any chartered accountant. So the very important thing is to start thinking about it, that there could be leads while doing the stat audit. There could be leads while doing the internal audit also, which will help us in taking to the next level. Similar to that, there are transaction audits are involved with the IBC process, and as CA, we can reach out to the insolvency professional for seeking out transaction audit work. And then subsequently, there are digital forensics involved into it. Then there are anti-money laundering activities. A lot of banks are appointing chartered accountants on their roles, off their roles, and also giving a lot of assignments as far as anti-money laundering, verification, KYC procedures, and all other things are concerned. I think we have already covered IBC with the transaction audit. So risk-based internal audit, maybe I can take a moment to discuss about it also. So traditionally, internal audit had been like a detailed vouching process, which is a traditional way of doing the internal audit. But now the time has come where we need to do a proper risk-based internal audit, and we also need to guide our clients onto setting up the system which can lead to a risk-based internal audit. Why this is important is because this is the very important step into any organization which can help us in finding the in-depth leads for the forensic investigations. There are a lot of companies uh, uh, who have a proper department within their organization, and they keep on doing this exercise on a regular basis. So they do it in-house, as in their internal audit or assessments, and when they receive any kind of, they actually appoint the experts from the outside to investigate further into it. And similar to that, the bribery and corruption charges, and a lot of government agencies also appoint the external parties for investigating the bribery and corruption charges also. In a few cases, we have also done this kind of work for CBI as well. So then coming to the financial statement frauds, I think everyone knows about it. And then there are a lot of data analytical and analysis work also, which is involved. So I can say that forensic audit could be a one word, could seem like a one practice, but this has got multiple practices area within one practice where a lot of chartered accountants can try and search for multiple avenues for their growth. Any questions so far? So while I'm going through the presentation, if anyone has any sort of questions, they can put it into the chat box, and we can take that subsequently.
Hi Jatin, I have one query.
Sure.
Who does this forensic audit? I mean, specific forensic agencies or the CA firms also eligible for this forensic audits?
So, depending upon kind of work, there are multiple regulations involved into this. So, chartered accountants are anyways eligible to do a lot of forensic audits. But they, for example, if you go for a bank forensic audit, they require the chartered accountants to empanel themselves with the IBA, and then IBA after the empanelment, bank gives a forensic audit to the chartered accountants. And similar to that, I mean. A lot of other insurance companies appoint agencies further appoint chartered accountants on their roles, and that's how it is. So it's a mix of all, but typically 90% of the work is handled by the chartered accountants. Empanelments may be different, ways may be different, eligibility criteria to do that kind of work may vary from organization to organization.
Okay.
So yeah, maybe if anyone has any other question, can put it into the chat box, and then we can take it subsequently. So coming to the process flow of forensic accounting is, so typically it requires a 6-step process. First is the initialization, where we develop our complete plan and initiate the forensic accounting process. And I've covered up the second step also along with that. Once we initiate it, we create a complete plan, how we want to do it, what kind of period we have to cover, what kind of processes we have to include into that. And that's what the planning part is. Then once the planning is done, we start collecting the evidence within the organization and outside the organization also. And then on to the subsequent step, we perform all the analysis for the data, which is collected through the internal and external uh, processes. And maybe I can repeat this: collecting of evidence is the most important step in doing any fraud investigation. So quality of data is very, very important. So for example, uh, in case we are doing forensic audit for an organization which is uh, getting it done because they are bound to get it done under certain uh, frame of law. but it is a typical mindset of any management that they don't want to reveal so much information to any of the auditor, and specifically to the forensic auditor. In such a situation, it is very important that we analyze the quality of the data which has been provided by the management. For example, there could be instances that the company is having 10 bank accounts, but they might only give you 8 bank accounts. So it really depends on our analytical skill whether we are able to find out those 2 additional bank accounts or not. And there are 2 ways of doing it. And I can share my experience how I do it. I run a third party investigation from the outside and try PAN based search, from where I try and find out from the outside that how many bank accounts could be there. And in 99% of the cases, I have always find out additional bank accounts. Maybe some of the accounts may be dormant, but it's good to have done this kind of an exercise so that you can see whether the information is being provided by the management in a proper manner or not. Then the next step is perform the analysis. So whatever data we collect from the inside and outside the organization, we perform the analysis. And then basis that analysis, we do our own reporting part. And once the reporting part is done, if there is a fraud or any other thing, we submit to the agencies or the organization who are the authorities for it, who appointed us. And then depending upon their requirement, they proceed for the court proceedings. So it is very important. Maybe I'll take a moment to discuss about the reporting and court proceeding. So whenever we do a proper forensic audit, it is very important to conclude the report. And I've seen this in a lot of cases where the smartest of the auditors are not concluding the report due to any XYZ reason. Conclusion means you say it, there is a fraud, or you say it, there is no fraud. Because you know what? If you say that this I cannot conclude or this was due to any other reason, it becomes very difficult for the principal who appointed us to take any further course of action. So the entire exercise goes for a toss. So it should always be an endeavor to do a conclusive report, any side, positive or negative. There could be disclaimers to it. So I'm not saying that limitations cannot be there. But my view, my personal view is, if there is a limitation, if the management is not supporting you, that means it itself that there is an intention problem, right? So if a management is saying, okay, I can give you the information, but I will not give you the information, or I have 10 records, I'm giving you 5 records, 5 are not available, that shows the intention. So if there is an intention problem, specify into your report that, okay, these had been limitations and the management had not been cooperating with us. That also is a conclusion, which really helps the principal who appointed us to take that conclusion to the next level. So now I'm going to discuss a few case studies, and then we will take a question and answer session. So a couple of case studies. So on the case study side, everyone knows about the Yes Bank scam. So everyone knows that there was a problem into the bank and the promoter was also behind the bars. So what could have my thought process here is not to discuss what happened and how happened. I want to emphasize what could have prevented that and whether there were red flags before that scam or not, which could have actually prevented a lot of shareholders' money and the public money at large, which could have saved a lot of money, right? So, I mean, specifically in the Yes Bank case, they had been having a lot of other income beyond their regular interest income. So they were reducing their interest typically to be very, very competitive, but they were trying to generate a lot of other sources of income, like a treasury income, trade finance income, and all other, like bank processing fees and all other things. And they were trying to be very, very competitive, or rather they were trying to kill the market to gain access to the lot of customers. And in that aggressive process of banking, so banking is a very unique business where you have to be very, very careful as far as risk assessment is concerned. You cannot give interest to your deposit holders at a higher rate as compared to the market, and you cannot give lower interest rate on to the borrowers as compared to the market rate. So both sides, if you are trying to squeeze, ultimately you are not trying to retain margin for yourself, and one-time incomes are not sustainable. And then of course risk assessment has to be very, very strong. Your book size cannot be dependent on few clients. For example, Yes Bank, PMC, Diwan Housing, they were all related. I mean, you were having a lot of exposure onto the related concerns. And in fact, Yes Bank was also having a lot of exposure on the uh, Anil Ambani group as well. So what I'm trying to say is, if you are uh, a bank, you have to be very, very strong as far as your internal controls and risk assessment procedures are concerned. Otherwise, you cannot survive. So now a very different case, which I also want to touch base upon very briefly, is about a Renbaxy fraud case. So see, Renbaxy is a very classical case where, in my opinion, I mean, although my opinion should not be here, but I'm just sharing. There is a very famous saying, let the buyer beware, right? Caveat emptor. I mean, my question to the Japanese investor was, I mean, you were buying a company. I understood that there were falsification of some of the information. There were falsification of some of the real facts. But when you were doing the due diligence and all other things, you had to be very, very careful as to what information is there in front of you. Like there were red flags on the US FDAs, but in my opinion, investors also fail to see those things. So I'm not blaming anyone here. What I'm trying to tell all my fellow colleagues here is, when we do a due diligence also, we have to have that kind of knack which gives us a forensic mindset, where we should try and see beyond what has been provided to us. So in any merger acquisition, it is one of a very, very crucial aspect of doing a due diligence and providing information to the management, where we have to go beyond what has been provided to us. Maybe I'm repeating this again and again, but we have to go beyond which has been provided to us. That's the basic of any forensic investigation. And if we are successful in doing that forensic due diligence in a proper manner, believe me, 90% of the problems post acquisition will be solved. So that's what my take is on the Renbexy fraud case. Similarly, similar to Yes Bank, there had been lapses on the KYC when it was a PMC bank fraud case. They really failed on the anti-money laundering compliance. They really failed on the KYC thing. And the answer to all this problem was strengthening the proper internal control systems. And that, of course, when the intention of the management was wrong, they never wanted to do a proper preventive checks or a proper internal control mechanism. And that's how and that's why these kind of frauds really happen. So what I'm trying to emphasize again and again here is, we need to have proper internal control mechanisms in place to be really able to safeguard and prevent all these frauds. This is what my take is.